Now, Nigeria's central bank governor has warned that despite recent economic gains, the country faces significant risk to stability, especially with elections looming next year. Governor Olayemi Cardoso told the National Economic Council conference that a large amount of liquidity remains in the system and election year spending could destabilize the gains made by the central bank. Now, Cardoso also cautioned that the monetary policy alone cannot stabilize the economy, highlighting food supply shocks, high energy costs, and global trade tensions.
Then, of course, there were direct interventions by the central bank, which reached an unprecedented level of 10.93 trillion naira, which honestly was a huge problem. And much as we have been able to calm things, we have to understand that these distortions are still very much hover around. These interventions provided short-term support, which many people would argue, but created long-term monetary distortions, excess liquidity, and increased costs of liquidity management. So this was where we were, in a very desperate situation. Liquidity overhang. There's a lot of liquidity that still remains within the system, and we've got to manage this very, very carefully. So we are not out of the woods yet. The election cycle, typically election cycle, a lot of money gets pumped into the system. This has to be watched to ensure that it does not destabilize and challenge the very, very bold reforms which have brought about stability to the economy. The global trade tensions, I won't say too much about this because I know everybody in this room follows what has been happening in the recent past with global trade tensions. The limits of monetary policy, I will say here that monetary policy is a necessary but insufficient tool. It can take us to where we have gotten to now, but it is no substitute for the fundamentals. No central bank can sustainably deliver low and stable inflation alone, where structural drivers such as food supply shocks, high energy and logistics costs, and infrastructural deficits are large contributors to price pressures. Liquidity management has boundaries. Transmission is imperfect where credit markets are thin and informality is high. That is why sustained gains require fiscal discipline, supply-side reforms, and institutional coordination.
Well, Nigeria's banking sector is navigating a critical transition phase, with new data showing strong earnings, rising assets, and improved capital buffers, but also mounting cost pressures and tighter credit conditions. A new sector transition report reviewing the 9-month 2025 performance says banks remained resilient despite soaring interest rates, inflation, and regulatory reforms, with recapitalization now reshaping strategy, profitability, and competition across the industry. Joining me now to discuss this further is Dr. Patrick Ejumedia, who is Head of Research at Sterling Asset Management. Good morning to you, Dr. Patrick. Always a pleasure to have you here.
Same here. Good morning once again.
Good morning, yes. Well, we've just seen central bank governor warning about excess liquidity in the system, as well as election year spending threatening economic stability. How serious is this risk from a macroeconomic perspective?
So again, it's about that time again. Election is next year, so this is a pre-election year. Of course, that risk is very serious. It's serious in the sense that before now, we've seen the gain that we've been enjoying in terms of inflation that's been declining. We've seen that stability in terms of exchange rates. But that risk can only be serious if there's a mistake in terms of from the side of the Monetary Policy Authority. Now, they've been doing a lot of things to see that they stabilize inflation and exchange rate. But if, for instance, they are unable to control it, to mop out excess money, excess liquidity, come the time when the election spending would increase, then that would lead to that worry that he's concerned about. But for me, I don't think it's too much of a worry, because they say once you know your problem, the problem is half solved. So now that I brought it up, I think the best thing for him now to begin to look for strategies to put in place to ensure that the coordination that we have seen between the monetary authority and the fiscal space, fiscal arm of government is still there. And then he's also put up policy to be able to mop out excess liquidity. And that's why in some speculations, when we're doing our forecast for monetary policy, the MPC rates this year, we are saying that we are likely going to see a tight monetary policy for 2026, and the reason is because of some of these things I has mentioned.
Right, but given the history of large intervention spending, do you believe that the current monetary tightening is enough to offset the potential election cycle fiscal pressure?
Yeah, so monetary policy alone cannot do it. I usually think about it like when you are trying to mop water in a room and there's the tap still running. If the tap runs faster than you that is mopping, you see excess water in the room. So that's what happens. So when monetary policy is trying to, even if they try to tighten the monetary policy and government is spending more, government spend more than what they are doing, there will still be inflation, there will still be exchange rate pressure and all that. And if they decide to increase more than the tap that is running, that is the spending of the government, you see what's going to happen is that it's going to come with a cost. That's going to drag growth. And that's going to cost, drag growth and cause other negative side on the economy. So I think what is important now is to know that monetary policy on its own cannot do it. There needs to be that coordination between both arms of government to be able to achieve the goal that they are setting to achieve.
Right, so that'll be very key. And, very fair analogy there as well with the mop. Let's look next at the latest banking sector transition report. What are your key takeaways from banks' performance for the first 9 months of 2025?
Interesting. The report, it depends on the parameters that you are looking at. If you are looking at it in terms of the loan to customers, you see that went up. If you are looking at in terms of deposit too, for year on year, 9 months, it also went up. If you are looking at the cost of the capital base too, capital base has also gone up. A lot of them have been able to meet their capitalization and all that. But in aggregate, if you are looking at the profit for the 9 months compared to 9 months 2024, there was a decline of about 4%. So that's a worry. If you're also looking at the expense, the cost of running the bank too, that has also gone up significantly. Then if you look at the impairment charges that they have also set aside for potential bad loans, it has also gone up too. So it depends on the parameters that you are looking for. I think the outcome is mixed.
No, certainly. But what's really interesting is that this report also shows earnings resilience despite macro stress. What for you were the biggest drivers behind this performance?
Yeah, it's obvious from the report. One, there's interest income that has also gone up because of the high interest rate that we have seen. They're able to take advantage of it, even though some of them are coming up in terms of high bad loans that we are beginning to see. So there's high interest income. There are also other income too that also went up. And there's also some level of cost management that we have seen because a lot of them are also going digital, and that is helping them to reduce costs. So those are the key factors, despite the macroeconomic condition that drove the earnings upward.
All right, but speaking of interest income, this has become a dominant earnings source for banks. Does that improve stability or increase vulnerability if rates begin to fall, that is?
Well, for me, they are doing the interest income side of it is the cost side of their business, So, but again, I think the worry should be if interest income begins to drop, if its deposit rate also dropping, the cost of funding, the cost of deposit is also dropping. Again, you're also looking at what is the rate of increase in loan. Is it also increasing? If that is increasing, then I don't think there will be something to worry about. But the more key issue there is that it's putting a signal for banks to begin to diversify in terms of their income.
Speaking of rate of increase in loans, that's a very interesting topic, possibly another for another day, but let's scrape on it very briefly. Given the current economic situation we are in, do you see a rise in that? In the metrics for
in the loan,
absolutely.
Yes, and that's the worry now, and that's why the CBN is coming up to say all of this, because the idea is that this year government will begin to prioritize growth. Don't forget that they had the first rate cut sometime last year. And this year they want to begin to prioritize growth to say, okay, they will cut rates. But now with this pre-election issue that is coming up, the worry now is a whole lot of work on the side of the CBN to say, should we cut rate? What if we cut rate and there's inflation? What if we cut rate and there's exchange rates? So they're asking those questions now because of the pre-election spending that they are emphasizing that we are likely to see. So that can only happen, the increased loan to clients can only happen if we begin to see the rate cuts. Although we saw some level, if you look at the money supply data that came out, we saw some level of increment in terms of loan to clients.
All right. Well, if we look at non-interest income, we saw that decline year on year based on this report. How concerning is the weakening revenue diversification trend?
Yes.
Should it be, to begin with?
So I think, yes, it's cause for worry, because what that means is that they are not diversified enough, like I said. So what is important now is for them to begin to look at a means of diversification. Yes, it shows that it decline, and the reason is not far-fetched, because when the interest rate is high and they can make more money from the interest, they put their effort there and all that. But because of the decline in the non-interest income, it is now a concern. It is a worry, but it's not an alarm yet. What they need to do is to begin to look at how to diversify their income, to look at other sorts of income. I think that's the major issue there.
When does it become an alarm?
Yes, it becomes an alarm when, interest begins to drop so much and they are not diversifying their income.
Okay, which is not the case.
Yes, so if you see it going far, the non-interest income begins to go, lower, they begin to decline, and we see interest rate dropping, you see, so the two sides are dropping.
Right,
so it becomes a problem.
We're certainly not at that point. If we look at this, we see tier 1 banks accounting for the bulk of sector profits and assets. Now, is the industry becoming too concentrated, in your opinion?
I don't think it's surprising. Tier 1 banks are the big banks now. They are the big boys in the industry. So it's not surprising in terms of capital. They are well capitalized. They have the assets and all that. So it's good. But I think the good side is that it makes the banks are big to be able to withstand shocks that happens. But the bad side is that, the innovation, the competitiveness in that sector comes from these tier 1 banks. So by the time they see themselves as big enough, they may not be bringing some level of innovation to that sector, except the tier 2 and other banks begin to strive to adapt, to bring some level of new creativity to that sector. Otherwise, you might not be seeing the sector grow. Those are some of the bad sides. Another bad side of that is that if there's anything that happens to any of those tier 1 banks, for instance, now it becomes an issue to the industry and all that. But overall, I think it's not surprising. They're big and they're able to drive competition and innovation in that space.
So do you think the industry is becoming too concentrated?
No, I don't. It's normal. It's not being concentrated. I think what's important for the tier 2 and other banks is to begin to look for some creative way to, to also begin to grow, even though the tier 1 banks are the one driving the sector. So I don't think it is. It's just because they are well capitalized, so they are big. So what do you expect? And
in all fairness, there is room. There is room for more to come in.
The creativity. How creative is those small banks to be able to come up?
It's not capped at any point.
Yeah, so nobody's telling you cannot grow.
Absolutely. That's always very important to note. Now, this report also notes rise in funding costs and margin pressure. Now, which banks are structurally best positioned to protect margins here? I know that we're not asking to name call particularly. Yes, it's going to be a tricky one.
But again, I don't think I want to mention the names of the banks right now. But I think the major issue is to understand what drives margin. Now, what drives margin basically is about cost control and income diversification. Those are two major factors that drives the margin. So any bank who is not able to play within that space will will have issue whenever cost of funding is going up. I think that's the major issue there. So
preparedness is always very key.
Exactly.
Here.
So either you are diversifying your income, whether you're a large bank or you're a small tier 1 or a tier 2 or other banks, the ability for you to diversify your income, the ability for you to cut costs, will make you such that when there's an increase in cost of funding, you may not feel the impact. But otherwise, smaller banks are expected to feel the impact of higher cost more.
Which is the reality at this point. Let's talk impairment charges now. For some people might not really understand that. So let's even begin with what that is.
Okay.
Yeah.
So impairment charges are just charges that banks set aside for potentially in case there's a bad loan. So they set it aside. So that's just it basically. Literally, that's what it means. So every time, because of the nature of their business, they give out loan, right? So they are giving out loan. They are saying that, okay, suppose this person does not pay back. Oh, suppose it's okay, let's set aside X, Y, Z amount. Suppose the person. So it's like So it's
a cushioning. Yes, it's an indemnity in many ways for the financial institution in itself. Yes. We saw these charges increase across the sector. Are we seeing early signs of asset quality deterioration?
So for me, I think the worry is not about whether the charges are increasing. The worry is that is it superseding the outcome, the actual outcome of the loan that is going up. So you are giving out loan, right? You are setting aside some amount of money, to take care of that if the loan becomes bad. But if you now have higher loan that is higher than the charges that you have set aside, it becomes a worry.
Okay.
Otherwise, it's not a worry. But again, it's just showing that the bank are setting some amount of money to say potentially if the loan becomes bad. It doesn't mean that the loan has become bad.
And it is a necessary risk
So
indemnity
yes,
anyway.
so what happened, and it's because of the high interest rate environment that we have seen so far. So what happened to now say is that the worry for people, or the worry for me as an analyst, is to say, okay, how much are you setting aside? Then how much is the real amount when let's say the loan now becomes bad? How much is the real amount? So if the real amount exceed the money that you set aside, then there's a worry.
Certainly. Okay, got that. So, I mean, let's talk recapitalization. As we know, looking ahead of 2026, the deadline is reshaping strategy. Yeah. It was quite the buzzword towards the end of last year as well. How is this changing competitive dynamics amongst banks?
Definitely. What recapitalization has done is that it has made the bank to become big. It has made them to begin to go digital. Banks no longer think of, instead of, there was a time bank want to have branches in almost every location. Now, because of digitalization and the use of some AI tools and digital tools, they are not thinking of that anymore. So what they look out for is to say, we need to cut costs, so we need to become more efficient. We need to become, so these are what they look out for and all that. So what the recapitalization has done for them is that it has improved, or it has increased their level of foresight strategic thinking. So that they begin to think, and they begin to think of how to cut costs. They begin to think of, what can we do differently? Because with recapitalization, like we have in the report, the problem is not about how big the bank is anymore. The problem will be which bank is able to deploy the deposit that it has, in terms of to efficient use.
So certainly banks are being, forced to think on their feet, basically pull their socks up in many ways as well. Very briefly, let's wrap up with mid-tier banks posting faster percentage growth. Now, is this a real competitive shift or mostly just a base effect?
Yeah, so there's a base effect on one hand. Base effect in the sense that before the recapitalization, where they were. So with recapitalization, they've now suddenly grown. So there's a base effect which has made them grow. But there's also a competitive effect, because a lot of them, as they are going into recapitalization, they are also moving into some new markets. You see a lot of small banks now beginning to go into trade finance, into SME loans and all that. So that is also creating some new part of business for the small banks, like we see.
Right, certainly very interesting times in the banking landscape for Nigeria, one has to say. If you joined us midway, I've been chatting with Dr. Patrick Ejumedia, who is Head of Research at Sterling Asset Management Trustees. Dr. Patrick, always a pleasure to have you. Many thanks for joining us. We'll see you again very soon.